Good day, grade 12 learners. Welcome to today's lesson. Our today's lesson is for economics. You'll see me for the first time. My name is Mr. T.S. Mhlongo. I will be taking you through economics from now on until the end of the year. This lesson is brought to you by Gauteng Department of Education in collaboration with Saibono Discovery Center. So welcome to grade 12 and congratulations for making it to grade 12. I know it was not easy. You had to work hard to be here where you are. So now we are in grade 12 and you have met me in economics. I will be with you. I will take you through from topic number 1 to topic number last until the final examination. I would like to take this opportunity to congratulate my colleagues who did very well in economics within Gauteng province. Well done, colleagues, for the great performance we have achieved. I will do my research and come back here. I will call you by names based on your great performance that you have achieved for last year's grade 12 results. To candidates, as we are here today, remember it's something new compared to what we were doing last year. It won't be easy. It will need your efforts, positive minds, and positive attitude so that you can be able to achieve. It is highly achievable, but it needs you to play your own part as much as we are playing our part to ensure that you get the basic information and also extraordinary information. As we meet here, we meet on the Economic Hub. We will be giving you everything that you require and that you need to know. Our lessons are mostly reflections. We deal with what has been covered in your class by your educator. And I work hand in hand with your educators also. I don't work alone. So ensure that you make use of the opportunity given to you in order to achieve with pride as you continue to march on in 2025. Our today's lesson is macroeconomics. Under macroeconomics, we are doing topic number 1, circular flow. So in the circular flow, we focus on the circular flow model, participants in the circular flow, markets, national account aggregates, and the multiplier, meaning we are covering the entire topic 1 under the circular flow. Like I've mentioned to you, I'm Mr. Mhlongo as your presenter of economics today and even going forward. Please join me so that we can discover what I have in the pocket for you. So the following are the lesson objectives that will be achieved during the course of this lesson. This lesson aims to improve your understanding as a learner on the following circular flow aspects: circular flow concept and diagram, importance and interactions between participants of the circular flow, circular flow markets, national accounts, and the multiplier. So these are the subtopics that will be tackled on this lesson. And I believe at the end of this lesson, there will be a high level of liberation and emancipation. It is believed that you already have this basic information as for your grade 10 and 11. You have an idea about the closed economic circular flow model that you started in grade 9, went on to grade 10. You know interaction between participants that were covered in grade 10. You know the difference between leakages and injections. You can list leakages, you can list injections, and you know their impact in the economy and GDP. You know circular flow markets in the closed economy. And then you even know all participants in the circular flow. So this is our lesson. There will be firstly the description of circular flow. Then we will draw here thoroughly the circular flow diagram from the scratch. And then we'll be mentioning and discussing the importance of participants in the circular flow. Then we'll discuss in detail the market in the circular flow, the importance of market in the circular flow. And then we'll differentiate between leakages and injections in the economy. We'll also take national accounts, which include income method, production, and expenditure. That's when we deal with the system of national accounts. And then we'll take care of the multiplier. So the circular flow model, remember, it is very important for you to know the topic itself, the circular flow. In here, we are all about the movement of goods and services as well as money between participants in the economy. This topic is important for you because it is very much important for you to know how is the economy established. Where do we start to formulate the economy? What are the important components or input of the economy for it to even be measured under business cycle? And then also it is important for you to know the different role players in the circular flow, which includes even markets. Why are markets there? What is their role in the economy? What do they do, these different types of markets, where we can count factor market, product market, financial market, as well as the foreign exchange? What is their importance? What is their link and interaction between markets as well as the participants? What is their duty in the economy as much as we have the duties of participants in the economy? Then we will check that if ever the economy, in the economy there's an additional income, what happens? We call that injection. If ever money is flowing out of the economy, what happens to the economy? That's when we talk about leakages, as they are the withdrawal of money from the economy. Also, it is important for you to understand and know that within the economy now we've produced, we need to check now the different methods of calculating GDP, which can be income, production, and expenditure. It is important for us to be able to discover the total income received by all factors of production within and beyond borders of the country. It is important for us also to know the production per industry or per economic sector, namely primary sector, secondary, and tertiary sector. Also, it's a key for you to know the expenditure within the country and beyond borders of the country, where we refer to the expenditure method. Which sector within the economy spend the most in the economy? And then what is actually the impact of import and export expenditure in the economy? So those are the part of the thing that you must know. And then going further, it is important also for you to be able to give the difference between the GDP that has been adjusted for inflation and the one that has not been adjusted for inflation. Then also knowing about the multiplier, you must know the importance of spending, why spending or consumption is important in the economy, and also why savings are important in the economy. That's when we talk about the effect of MPC and MPS. That's when now you even know the multiplier effect, that as the smaller initial spending is injected into the economy, that will mean the money can be multiplied through multiplier effect. So it can be a smaller initial spending occurring in the economy, resulting to the greater change in the aggregate national income in the near future. So that's your topic. Now, talking about the circular flow model, this is where now we discuss, what is it? We discuss the flow of goods, services, as well as money between participants in the economy. Remember, it is important for you when you define the circular flow that you focus. If you say it is the flow of goods and services, then you discuss what we call a real flow. If you say it's a flow of money or income, you discuss the money flow. But if you combine both the flow of goods, services, and money or income between participants in the economy, that now when you integrate both the real flow and money flow, which will be giving you the circular flow. So this is the circular flow model. Firstly, we have what we call the household. So we know that households are the primary owners of factors of production. They sell their factors of production via factor market to who? To firms and the government. And in return, firms and government pay for those factors of production the income in terms of wages, salaries, interest, rent, and profit. So we can see factors of production flowing from the household going down, but they are sold through the factor market. Remember, the factor market is the market where factors of production are traded. This is also known as a resources market or input market. Remember, these factors of production are the key input for the production to occur. They are integrated together by entrepreneurs to produce goods and services. Factors of production that are found in here include labor, capital, interest, and entrepreneurship. Then, labor, capital, the land, and entrepreneurship. Then they are also paid for. Remember, labor receive wages and salaries, land receive rent, entrepreneurship receive profit, and also capital receive interest. Then we have the second participant there, which is the government. Then we see the factors of production are sold from the household via factors market to the government and also to firms. So we can see factors of production are going there. Then also there is also flow of factors of production going down there. They are going to firms now. These are the main components that purchase factors of production from firms. So now then in return, we'll see the income flowing back. Remember, I said they are paid for. So they are paid for in terms of wages, salaries, profit, interest, and rent. So we see remunerations that I've just mentioned, they're going back now. So what are the households paying for? They're paying services that have been rendered by the household via factor market. And then we see also it is being paid for by the government. The government is paying work done by the employees, which are the household in this case. There you see remunerations going back. Then the income is going straight to the household. So they are receiving their income now. So remember, as they receive their income, that's a part of the money flow. So after that, they will be paying tax to the government. That is what we call the direct tax, which is a personal income tax as a part of the pay as you earn. So they pay tax, which is T in there. As they pay tax to the government, what does the government do in return? The state intervenes by taking this money and provide public goods and services to the society. Then you can see goods and services are provided by the state to the household. And then we can see the creation of what we call of the goods market. So there is the market. Remember, we say market is the place, or goods market is the place where buyers and sellers meet to exchange goods and services. So as you see goods market or product market being created there. So who create the product market? Firms are responsible to create the product market for consumers. That's why you see goods and services flowing up to firms, to the product market. As they flow out to the product market, the goods are leaving the factory to the market so that consumers can leave households, can leave their homes, going down as households to buy goods and services. We can see now goods will be going there, but then let's see. Goods and services are purchased by the household. We see them buying goods and services, and in return, they pay for them. You can see an upward arrow indicating goods going to the household, and also, the income payment for goods and services flowing down to the product market to pay for goods and services. And also, these goods are also paid for to firms. And then we see also an arrow going into the government. This arrow indicates what? It indicates the taxation paid by markets to the government. So we see, let's check again. So there is a payment. So let's see, the government also, remember, the government also buys goods and services. Those goods are bought as what we call as economic goods from firms via product market, but they are sold, they're provided to the society as what we call, they're provided as public goods and services. So if ever the government come to buy goods from firms, those goods are bought through the market. So those goods are bought as economic goods. But whenever they are provided to the society as public goods and services, we call them what we call the public goods and services. But initially they were economic goods when they were bought from the market. And then payment for goods and services, we can see the money is going to the product market, which is intended to go to firms because firms are the main producers of goods and services. So we can see goods are paid for also. Thereafter, we have the financial sector in there that is existing, whereby if ever we need an additional money or extra money, we borrow money from there, or if we have an extra money as participants, we save or invest our money into the financial market. Then you can see the money flowing into the economy. That arrow indicates the money flowing into the economy, meaning those are our borrowings or our investments are ready to be used. So they're flowing back into the circular flow as injections. And then you can see those are borrowings now. We are borrowing money from the financial market. All commercial banks are giving us money so that we can be able to further our economic objectives. And then also, what happens if ever we want to save, so we can save our money out there to the financial institution or financial sector. Any additional income that we have, we can save it in financial sector. And then we also have the foreign sector in here, which exists when we have to import goods or we have to export goods or we have to be involved in any of international trade practices. So we see an arrow coming in. This arrow indicates what? It indicates the import flowing into the country. So these are the imports. As a household, we can import goods if ever we are faced by the scarcity of goods and services. Also, we also import because of the lifestyle. If we need to get some goods because of the state taste and preference, we can import from other countries. There you see an arrow going out, which indicates the payment for goods and services that have been imported. So the money flows out of the economy as a payment of import. And then we have exports going out. So we produce goods and services as firms in South Africa, then we are selling them abroad. The arrow here indicates goods that are flowing out of the economy. Then there will be, and we call them exports. Then also there will be the payment for export flowing into the economy. So you can see an arrow coming up here, which indicates that in South African economy, we do receive the income in terms of foreign currency as payment for export that have been sold abroad. So that's a payment for exports. And then now firms have made their profit. What do? They then pay tax to the government. We call that taxation the business tax or corporate tax or company tax. So they pay to the government, and in return, that's taxation. In return, the state intervened by providing public goods and services to these businesses. Also, the state intervened by funding smaller businesses that are existing in the economy. You can see goods and services also. It can also be the outflow of money from the government, where the state funds the smaller businesses with subsidies so that they can produce more goods at the lower cost per unit. So this portrays your circular flow model in the open economy. So the four-sector model circular flow, the inclusion of the foreign sector formulates open economy. Remember, we have two types of economy, namely the closed economy and the open economy. The closed economy does not include the foreign sector, while the open economy includes the foreign sector. So this is when a country is open to trade with the rest of the world through import, export, investment, and transfer of capital. That's when we can be able to interact with other world countries in terms of furthering our economic activities with them. The equation for the open economy is GDP equals to C plus I plus G plus open the bracket X minus M, which means C stands for household sector, consumption spending by the household, I stand for business sector, investment spending by businesses, G stands for the government sector, and then which is the government spending, then plus open the bracket X minus M, close the bracket. X stands for the payment for exports, and then minus import, which is payment for import, that M. Remember, imports must be subtracted because they result to the outflow of money from the economy. The X minus M part of the equation shows net exports, which is the difference between exports and imports. Then now we talk about the participants of the circular flow. Remember, we have households that are also called consumers. We have businesses that are also called firms or enterprises. We have government that is also called the state. Then we have the foreign sector. These are the basic four participants in the open economy. So you must know their importance. Why is the household important in South African economy? Or how can the household contribute on building South African economy? Why are businesses important in the South African economy? Or how can they contribute on building the economy? Or evaluate the impact of businesses in South African economy. The government. What is the importance of government in the economy? The foreign sector. Why is the foreign sector necessary in the economy? So we check the role of households. Remember, we say households are the primary owners of factors of production, such as the labor, the capital, entrepreneurship, and land or natural resources. So households sell these factors of production to businesses or firms as well as the government or the state. Whenever they own these production factors, namely capital, land, entrepreneurship, as well as the labor, it is sold to either businesses and the government, and they are paid for. You saw in our diagram there. Factors of production sold by a household are converted to goods and services which contribute to the GDP of the country. We know that these factors of production are converted, they are integrated, then they are converted as they produce goods and services. So then the output will be goods and services, but these production factors are the inputs that are integrated together to generate the output, which is productivity. And then household earn income and pay personal income tax to the government, which is necessary for provision of public goods and services. So after the household have received their income, as they've been working for either the government as well as firms, they receive income and pay personal income tax to the government, which is important for the redistribution of income and wealth. Households are the primary consumers of goods and services from firms through product market. We know that households are the one that contribute the most in expenditure in South Africa. They consume the most of their income as they purchase durable consumer goods, semi-durable goods, non-durable goods, as well as the services in the economy. So that the primary consumers of goods in the economy. The increase in demand for goods and services by household increase the demand for labor and lead to job creation. We know that if ever households are demanding more or consuming more goods and services, that will lead to firms and government demanding even more labor, which will lead to even more demand for labor and the job creation. The purchase of consumer goods and services from the product market is accompanied by the indirect tax, which is VAT, value-added tax, which positively contribute to the state revenues. So as consumers are purchasing goods and services from the market, they pay the market price. As they pay the market price, that simply means they are paying the indirect tax or value-added tax to the government for the purchase of specific goods and services, which contribute to the government revenues. Households employed abroad earn foreign currency as they as they are remunerated or paid for their factors of production that increase the country's national income. If ever the household is employed abroad, they do what? They receive income in terms of the foreign currency, which contribute in South African national income. Then businesses, why are businesses important, or how can they build the South African economy? Remember, they buy factors of production from households and remunerate them, which forms the initial money flow in the economy. Remember, businesses are the source of employment and the source of income for the household that is regarded as employees. Businesses transform factors of production into goods and services which are necessary for GDP creation and economic growth. Remember, these goods that are produced by businesses or firms are very important as they contribute to the GDP creation of the country. Businesses pay corporate tax or business tax or company tax on their profits to the government, which is redistributed to fund small businesses in the economy. We know that as businesses are paying their business taxes, the state will take that money and fund smaller businesses in the economy. Businesses are the main exporters of goods and services to foreign markets, which earns foreign currency for the country. So as our businesses are producing goods locally and sell them abroad, that means they earn the foreign currency for the nation. They increase wealth of the country through the capital formation or the purchase of assets. We know that businesses are responsible for purchasing assets for them to produce goods and services. So that contribute to the capital formation of the country. We call it gross capital formation or investment within the country. That is done through the purchase of assets. When they buy assets, that increase the capital formation of the country. They create job opportunities for all levels of labor, namely skilled labor, semi-skilled, and non-skilled labor, which in return earn them income. So the importance of the government or the state. So the state provides infrastructure to create great platform for businesses to function in the economy. We know that the state is fully involved on ensuring that it provides the proper infrastructure, both economic and social infrastructure. If we talk about economic infrastructure, we refer to infrastructure that support economic activities. So that's when the government intervenes to provide infrastructure. By providing that infrastructure such as airports, seaports, roads, that infrastructure is very important for businesses to function so that they can further their economic objectives. Businesses provide direct and indirect subsidies. The government provides direct and indirect subsidies to businesses. So the government provides both direct and indirect subsidies to businesses in order to increase productivity and improve the economy. We know that the state is fully involved and it's responsible to provide subsidies, which can be in a form of cash as direct subsidies or in a form of any other support as a part of incentives or indirect subsidies to businesses so that they can produce more goods and services at the lower cost. The state provides public goods and services to the society to reduce high level of inequalities and improve social welfare. We know that the government is fully responsible to provide public goods and services to the entire society so that there can be reduction of poverty and inequalities within the economy. So that means there will be improvement of social welfare. The state provides social transfer to the underprivileged to reduce economic marginalization. We know that some people are marginalized in a way that they cannot even afford the basic living. That's when the state intervenes by providing some social transfers to them so that they will be able to afford the basic living. Remember, if it's a transfer, that means it is the income that is received by an individual without having to work for it. Then we call that one a transfer. So some of the social members are underprivileged in a way that they don't have any source of income. So as the state intervenes, it provides them with social wages and other basic forms of income so that they will be able to afford their basic living. Then the foreign sector. How can the foreign sector contribute on building South African economy? The foreign sector creates the platform for business to participate in the foreign market. So without the foreign sector, our businesses cannot participate in foreign markets. There must be foreign sector being active and involved in the economy so that there can be foreign market being created. Then it reduces scarcity of resources in the world through importation and exportation. We know that the foreign sector is also responsible for allowing the import of goods and export of goods. So that is there to reduce the scarcity or shortage of goods across world countries. It contributes to job creation through the foreign direct investments. We know that FDIs are fully responsible for creation of job opportunities as they flow into the country. If ever an FDI invests in South Africa, that simply means there will be some jobs created in South Africa, which will be contributing to job creation and also reducing the unemployment in the country. If we talk about the FDI or foreign direct investment, we refer to foreign businesses that have decided to invest in South Africa by starting the company or buying existing company. So they do that so that they can be a part and the parcel of daily operation for the company. It promotes globalization. We know that if ever there's the foreign trade, globalization can easily be promoted because globalization can exist if ever there are no trade barriers between world countries to make the world a single society. Then we continue interaction between participants. So in this situation, we are looking for the link between different participants in the economy. Firstly, we look at the interaction between household and firms. How do they link? Households sell their factors of production to firms, and in return, they earn remunerations in terms of wages, salaries, profit, rent, and interest. And then firms produce goods and services and sell them to household, which in return, household pay for them. So we know that firms are the ones that are selling goods and services. So they produce goods and sell to the household via product market, and in return, households are paying for those goods and services. Businesses create a market for households as consumers. As consumers buy consumer goods and services. So we know that the businesses will create the market for consumers, and consumers will in return buy goods and services from the market. And then the household and the government. So households sell factors of production to the government, which in return the state pay remunerations in terms of wages, salaries, profit, interest, and rent. So those are the remunerations that are paid by the government to the household. Household pay personal income tax to the government and value-added tax as they purchase goods and services in the market. The government makes provision of public goods and services to the society to improve standard of living and reduce economic inequalities. So the households are responsible for paying tax, both direct and indirect tax to the government, and in return the state receives that tax revenue and redistribute income redistribute that particular income to the society to make other lives better. And then government and the businesses. Businesses pay corporate tax or business tax to the government on their profits, and the government provide public goods and services to businesses such as water, electricity, etc. Businesses sell economic goods and services to the government, which are converted to public goods and services, and then the state will pay for those goods and services. The government gives contract to businesses in a form of public-private partnerships or tendership, and businesses complete projects, and also they receive income for that. Then businesses in the foreign sector. Businesses produce goods and services and export them to into the foreign sector. In return, foreign sector pay for those exported goods and services. Foreign sector import goods and services, especially capital resources, to local businesses to further their business objectives. Businesses pay for imported goods and services or capital goods to the foreign sector. And then we check flows. We have two flows, the money flow and the real flow. We have an idea that money flow is the flow of money or remunerations or income, while real flow is the flow of goods and services, as well as factors of production between participants in the economy. So we're starting with the real flow. So real flow is the flow of goods and services within the economy. Then the flow of factors of production from the household to businesses, government, and the foreign sector is also regarded as the real flow. And then these are the examples of real flow. We have real flow here, and then goods and services. We have factors of production. We have imports, and then we have export. These are the main components of the real flow. Goods and services are the part of the real flow. Factors of production are the part of the real flow. Imported goods as well as exported goods are the part of the real flow. So we can see in this situation, workers are working in here, providing their factors of production, which is labor. And then also this side, we can see goods flowing from the market to the household. So they've just bought goods and services from the market in here. Then the money flow. Money flow is the flow of money or remunerations or income between participants in the economy. So the flow of remunerations for factors of production, the flow of savings, the flow of taxes, the flow of investment, the flow of expenditure, and financial capital are examples of the money flow. So let's check. Payments for goods and services is a part of the money flow. Remunerations in terms of wages and salaries, profit, interest, and rent. And then also savings and borrowing. Whenever money is saved, moving from the household or from the business to the commercial bank, that's a money flow. Whenever the money is borrowed from commercial bank, it flows to the circular flow. That money flows in as a part of the money flow. And then also we have taxes. Whenever money is moving from household to the government or firm to the government in a form of tax, that's regarded as a money flow. And then also we have investments. Whenever financial investment takes place, that means that's a money flow, because whenever one pays money or deposit money into the commercial bank for the particular period of time, we call that financial investment. That means money is leaving the economy. That's what we call the money flow. Money flow and real flow will approach opposite direction, because some of them are the expenditure. So in here, one is buying a product, one is doing what? One is giving out the product. So they always go to the opposite direction. Leakages and injections. Remember, leakages refer to the outflow of money from the economy or withdrawal of money from the economy, while injections refer to an additional money that have been thrown into the economy, or it refers to having an additional income into the economy. So an injection is defined as any spending which is not derived from income. Injection represent the introduction of additional money into the economy. If ever there's additional income into the economy, we call that what? An injection. Injection is therefore the inflow of money into the economy. So we define it as an inflow of money into the economy. The symbol J is used to denote injection. The formula for injections is J equals to I plus G plus X. I stand for investment spending by businesses, the government spending, as well as payment for exports. So the following is the list of injections, which is investment spending by businesses, government spending, as well as the payment for exports. So investment spending by businesses, which is I. Investment spending is an injection when domestic businesses buy more capital goods from other domestic businesses. So establishment of businesses or company locally is an injection which with a large multiplier effect into the economy. Whenever one establishes the business, there will be more money flowing in. Foreign direct investments to South African economy form the part of valuable injections with job opportunities and the economic growth effect. The increase in capital stock, such as machinery and equipment, has the spillover effect on job creation. Whenever there are more machines that have been bought, that means there will be more demand for labor. Or maybe if ever we become capital intensive, there will be less demand for labor because of what? Because of the increase in the number of machinery and equipment. The government spending. Government spending is when the government spends money to pay for infrastructure project, payment for wages and salaries for civil servants, and provide the public goods and services. That's when the government spends its money. When the government spending increases, the level of income increases in the economy, which results to the increase in aggregate demand. As the government spending increases, there will be more income available in the economy, which will spill over to increase what we call the aggregate demand in the economy. Infrastructural projects by the government form a large portion of job creation in the economy. So if ever the state intervene by providing or developing infrastructure, there will be job opportunities that will be created by those companies that will be operating. This includes both social infrastructure as well as economic infrastructure. If we talk about the social infrastructure, we refer to the likes of schools, hospitals, city parks, clinics, etc. But economic infrastructure, we refer to harbors, we refer to airports, we refer to seaports, roads, shopping centers, etc. The exports. Exports earnings are the spending by foreigners on the domestic goods and services. So when local businesses sell more goods and services to the foreign sector, the flow of spending, production, and income will be increasing. Foreign spending for on local minerals and other raw material is a great injection into the economy. The increase in the volume of export has a stimulus effect on gross domestic product, gross national income, as well as economic growth. So if ever there are more exports that are flowing out, we expect more income to flow into the country. And then what are the effects of injections? So we know that injections are having the positive impact on South African economy. As they increase, the economy will also be increasing. There is therefore a positive relationship between injections and the economy. So the higher are the injections, the higher is the economy. The lower are the injections, the lower is the economy. If there is no money added in the economy, that will mean the economy is not going to grow. Leakages. So we regard leakages as the outflow of money from the economy. We have savings, taxation, as well as the payment for imports. So we check leakages as L in there. A leakage is any flow of money which does not give a rise on the further or to a further round of income within the economy. Leakages represent a withdrawal or outflow of money from the economy. The symbol L is used to denote leakages. Leakages represent the outflow of money from the economy. The increase in the amount of leakages decreases the economy because money will be flowing out of the economic sector or of the economy. This illustrates the negative relationship between leakages and injections. We have an inverse relationship because as leakages are increasing, economy will be decreasing. The formula for leakages is we say L equals to S plus T plus M, savings plus taxation plus payment for imports. That's a formula for leakages. And then we have savings. Remember, savings is a leakage since a part of the income of household that is not spent. You receive your 10 rand, you decide to save 8 rand, you only spend 2 rand. So your savings are the part of the leakages because they withdraw money from flowing into the economy. So an increase in the savings by household will decrease the flow of spending, production, and income since households spend less on consumption. So if ever households are spending less in the economy, that will mean they will be saving more. Leakages will be increasing. Net savings is a difference between borrowings, which are loans by household, and savings. It is the net amount that is the leakage. Money saved is not available in circulation for consumption spending. It is therefore detrimental to production, consumption, GDP, and economic growth in the short run. Whenever money is saved, that money is not available easily in circulation. So it cannot be used easily. If you fix your money in the bank for the particular period, that money cannot be available to be spent. Taxation. The introduction of taxes into the spending or income decreased real income and disposable income. We know that whenever our income has been lowered, the disposable income will also be lowered because of the increase in tax. Should the tax be increased, our personal income tax be increased, our disposable income will be lower. Should the value-added tax be increased, that will mean our real income will be decreasing. Remember, real income refers to the quantity of goods one can afford with the available income. The decrease in the spending in the economy caused by taxation is detrimental to the production of goods and services and even further investment by businesses. If ever tax has been increased, that will lead to less disposable income in the economy. That's why we say the decrease in tax in spending in the economy caused by taxation is detrimental to the production. It will lead to less production of goods and services and also investment. Any kind of taxation withdraws money from the economy. So I know that there are different questions to say, why is taxation not regarded as an injection? Because the government uses that tax amount to fund businesses and also spend in the economy. No, tax is not an injection, it's a leakage because it results with the outflow of money from the economy. So as money goes out of the economy to the government, that money cannot be spent. It is only on the side of the government until it is redistributed back into the economy. We have imports. So payment for import is the outflow of money from the local economy. It has a negative effect on the local economy because domestic producers are compromised for import, also because money goes out of the country to pay for those goods and services. So the imports can be denoted by letter M or Z, which are spending on foreign goods and services by local people. If ever local people or local consumers are demanding goods from other countries, that is regarded as importation, which is not good for the country because it leads to money flowing out of the economy. If consumers demand most of the import, local businesses are discouraged and that lowers the level of productivity, GDP, and economic growth. So if ever local consumers decide to import most of their goods than demanding local firms will be compromised, which is bad for our economy. The total leakages, which is L equals to net savings, which is S, net taxes plus, import, which is Z. Total injections, which is J, equal to investment plus government spending plus export. the economy is in equilibrium when injections are equal to, the economy is in equilibrium when injections are equals to leakages. So we say J equals to L, then we have economic equilibrium. But when the economy, leakages are more than injections or injections are more than leakages, we have economic disequilibrium. That's when L is greater than J, economic disequilibrium also in there. So let's be aware, if leakages are more than injections, economy will decrease because money is flowing mostly out of the economy. But if ever injections are more than leakages, economy will be increasing because more money is flowing into the economy. But if injections are equal to leakages, we have what we call economic equilibrium because both injections are leakage and leakages are equal. So we talk about circular flow market now. Remember, the circular flow is a part of the essay on our current examination guideline. So they say discuss in detail the importance of 4 markets in the circular flow, namely the factor market, the product market, financial market, and the foreign exchange market. So let's check. We start with the factor market. Remember, this is the market where all factors of production are traded, and these factors of production include labor, the capital, entrepreneurship, as well as land. And then it is also known as inputs or resource market. Why we call it input market? Because factors of production are regarded as input. We input them in order to get the output. So that's why we call it input market. Firms and government buy factors of production such as labor, capital, entrepreneurship, and natural resources as a real flow from household through this market. All four factors of production receive remunerations in a form of wages and salaries, interest, rent, and profit, which is the money flow. Labor market is a component in this market where labor is traded. So we subdivide this market into labor market also because this is the market where labor is traded. Production cannot occur without factors of production because it possesses all inputs that are transformed to output. So we cannot produce without the availability of factors of production or factor market, because without factor market, that means you won't have factor of production to produce goods and services. Then we have our factor market simplified: factors of production as the real flow and remuneration as the money flow. So we have labor, wages and salaries, capital, interest, land, rent, entrepreneurship is profit that is received. Then we move to goods market. So why is factor market important? It is important because no production can occur without the availability of factors of production. So goods market or product market, this is the market where goods and services are traded. That's where consumers buy their goods and services. A goods market is subdivided into consumer market, consumer goods market, capital goods market, as well as the services market. Let's talk about consumer goods market. That's a market where consumer goods are traded. So in there, we come across durable consumer goods, semi-durable, and non-durable consumer goods. It is the market where consumers buy final goods and services to satisfy their needs and wants. It contains durable goods, consumer goods, semi-durable consumer goods, and non-durable consumer goods. Remember, it is important for you to be able to explain in detail those consumer goods. If we talk about durable consumer goods, we refer to goods that can last for the longer period of time, such as houses. Semi-durable, we talk about goods that can be used for more than once, e.g. clothes. And then non-durable, we refer to goods that can only be used once, e.g. food. Capital goods market is a market where capital goods such as machinery and equipment are traded. That's why we have capital goods market. Services market is the market where services are traded or rendered. Product market is not directly involved in production but acts as a mediator between what we call consumers and producers. So the product market does not produce goods and services, but it's a market as it acts as a mediator because it is a middleman. Consumers come and buy goods from the product market, producers bring goods into the product market, so it functions as a middleman. So it's a mediator. Then the financial market. Remember, the financial market refers to the market where all financial securities are traded or take place. It is a destination designed for investment, borrowings, and savings. Financial market contains insurance companies, commercial banks, central bank, and JSE. So it can be subdivided into, so before that, financial market is the main market for wealth creation in the economy. It is important because it leads to the wealth creation in the economy also. It is not directly involved in production, but function as a mediator between participants, because for commercial banks to get capital, they must borrow from, For firms, I mean, to get capital, they must borrow from commercial banks. And then also for the household to get extra income, they must also borrow from commercial banks. So in that case, they don't produce goods and services, but they act as a middleman or mediator between participants. It enables the flow of money and capital between economic participants in the economy. Financial market is a source of capital for businesses and investors. So investors get capital from what we call the financial market or financial sector. Financial market acts as a financial custody in the economy. Remember, it keeps savings and investments for their clients or for the household. It is not directly involved in production, but acts as a mediator between participants. So we know that under financial market, we don't produce goods and services, but we make provision of financial resources. So should firms be in need of the capital, which is the financial resource, they borrow that money from commercial banks, which is a part of the financial sector. Financial market is divided into money market and the capital market. So let's see in details the money market. Remember, money market is the market for short-term loans and deposits by the private sector. So the banking sector, insurance companies, and central bank are the main components of the money market. Household, businesses, and the government are the main participants in the money market. So we know that households are borrowing more money in the businesses are also borrowing more or investing more money. Also, the government needs money from financial institutions. Debentures, treasury bills, and government bonds are traded in the money market. In South Africa, money market is controlled by South African Reserve Bank. We know that. Then we go to the capital market, which is the market for long-term loans and deposits by the private sector. We call that one a capital market. Mortgage bonds are examples of the capital market. Johannesburg Security Exchange is a key institution that controls capital market. So we know that JSE is fully responsible for the control of what we call the capital market. Shares are traded on this kind of the market. So we also trade with shares in the capital market in there. Then we move to the foreign exchange market, which is also a component of the financial market, if we explain in details. Foreign exchange market is the market where different world currencies are exchanged to one another for the sake of importation and exportation. These transactions occur in financial markets. So we know that the exchange of currencies takes place in commercial banks. The biggest foreign exchange market are in London, New York, and Tokyo. These are the biggest foreign exchange markets in the world. South African rand is freely traded in these markets. Hence, we have a free floating exchange rate. The importance of the foreign exchange market. Why is the foreign exchange market important in the economy? The foreign exchange market enables the exchange of goods and services between world countries by making world currencies available. We know that the foreign exchange market is the one that is necessary to ensure that firms can be able to exchange their own currencies. So that is done in there. It is necessary for international tourism and foreign direct investments. We know that if ever local people want to tour to the foreign country, they will need the currencies of that particular country, which will then be needing what we call the foreign exchange market. Foreign exchange market plays a critical role on facilitating cross-border trade, investment, and financial transaction. These markets allow firms to making transactions in the foreign currencies to convert their currencies or deposit they have into the currencies or deposits that they want. So you can simply exchange your own currency to the foreign currency. Then we move to the national accounts. So here we have the national accounts, which talks about income method, production, and expenditure method. Remember, this is about system of national accounts, which is the internationally agreed standards between world countries, which they have to comply on them as they compile national accounts. So what is its function? Mainly it functions to do what? To ensure that there's a better standardization of the economy between world countries. There's a simple comparison, so they can simply be compared with one another. And then also it monitors how income, expenditure, and production flows from one participant to another within the economy. That is the system of national accounts. So the income method. So what does it measure? It measures total income earned by all factor of production of the country within and beyond the borders of the country. So that's when we talk about labor, capital, land, and entrepreneurship. So that's when we have income earned by all of these factors of production. Remember, labor receive wages and salaries, capital receive interest, land receive rent, and then entrepreneurship receive the profit. These factors of production are inputs integrated to generate the output in the economy. The utilization of each factor of production earns remuneration, which sum the GDP at factor cost. Remunerations are wages and salaries for labor, interest for capital, rent for land, and profit for entrepreneurship. The factor cost. What is meant by the factor cost? So the factor cost is the cost of all factor of production consumed or used during the production process. Whenever firms are producing goods and services, then they are using factors of production, which will be generating what we call a factor cost. Factor cost is calculated by adding all factors of production used in the production process of goods and services. Compensation for employees, net operating surplus, and consumption of fixed capital are added to convert GDP at the factor cost. Compensation for employees is a cost of labor in a form of wages and salaries, while the net operating surplus is the profit earned by the entrepreneurs. Then in explanation, compensation for employees. So compensation for employees is defined as total remuneration in cash or in kind payable by enterprise or to an employer in return of work done during the accounting period. Compensation for employees has two main components, which are wages and salaries. Compensation for employees contribute the most in a country's national income, because the money that is mostly accounted for in the economy is from what we call compensation for employees under income method. These indicate that labor cost is the highest amongst all factors of production in the economy. The net operating surplus. So that refers to the amount, if any, by which operating revenues for that period exceed the operating expense that for that particular period. In this case, we talk about the profit received by businesses after sales. This is the profit made by enterprises or business as they compare their income and expenditure. This net operating surplus is earned after all taxable income has been subtracted, while with all costs, which include cost of land, cost of capital, and cost of labor. The net operating surplus is earned by entrepreneurs for a particular accounting period. So it's a profit that is received by entrepreneurs for the particular period of time. Then we have CFC, which is the consumption on fixed capital. So if we talk about this, we refer to the depreciation or value lost by an asset during the production process. So CFC reflects the decline in the value of a fixed asset for enterprise, government, and owners of dwellings in the household sector. A fixed asset decline in the value due to normal wear and tear. And then we continue. Consumption on fixed capital is used in preference to depreciation to emphasize that fixed asset is used up in the production process as firms are producing goods and services. When the machine is new today, it doesn't mean it will be new forever. Once it's used to produce goods and services, it will be doing what? It will be losing its value, which is known as a consumption on fixed capital or depreciation. So be aware that as much as the CFC increases, if consumption on fixed capital increases, that simply means the asset is getting older. So as the asset gets older or machine gets older, the CFC will also be increasing. CFC is the decline during the course of the accounting period in the current value of the stock of fixed asset and owned. Fixed asset owned and used by the producer as a result of physical degradation or normal accident damage. We know that as goods are being used, machines are being used to produce, they become older, which results to them losing more value, which is a part of consumption on fixed capital or depreciation. It normally increases as the asset gets older. We know if ever the asset is becoming even more older, the CFC will also be higher because more value will be lost by an asset in a form of wear and tear. And then converting a GDP at factor cost, we do the following. Compensation for employees plus net operating surplus plus consumption on fixed capital, we get GDP at factor cost. So they are all positive. And then GDP at the basic price. So basic price is the cost of output within the factory or within the particular industry phase before taxes on products have been added and subsidies have been subtracted. We know that whenever we convert this basic price to the market price, we will be adding taxes on product and minus subsidies on products. Basic price is convertible when GDP factor, at factor cost is added to taxes on production less subsidies on production. Tax on production. So it refers to taxes on production that are not linked to the specific product or good per unit. That include the payroll, the payroll taxes, business licenses, and property taxes paid by businesses. That is known as taxes on production. Subsidies on production refer to the subsidies that are not linked to the specific product or unit per unit within the economy. That the example for that can be employment subsidy. Also, employment subsidy is one of the best examples that we can use to show the tax on the subsidy on production. So to convert GDP at what we call at the basic price, we take the amount in there for GDP at factor cost. It's positive. We plus taxes on production. We subtract subsidy on production. Then we get 2,635,804. The market price. What is mean by the market price? Market prices are the prices paid by consumers for goods and services in the market. Whenever the consumer is buying goods from the market, the consumer will be paying market price, not the basic price. Basic price is only payable within the factory phase. They include all taxes on products, less subsidies on products. So for us to obtain GDP at market price or market price, we must add all taxes on product and subtract subsidies on products. Market price are considered as the current prices because they've been inflated. They have inflation effect. Market prices are always higher than the basic price because they have an effect of value-added tax. So the market price, remember, has been given the 15% extra of VAT, while the basic price does not have the effect of value-added tax. That's why we say the market prices are always greater than the basic prices. This inflates the earnings and contributions by the tertiary sector in the economy's GDP. Converting GDP at basic price to GDP at the market price. So we carry on GDP at basic price, which is 2,635,804. We plus taxes on product, which is 305,222. We subtract subsidy on product, which is when now we say we might minus, what is it, 52,278. We get 2,888,748. That's our GDP at the market price. Then how can we convert GDP at market price to gross national income? Then there we go. We say GDP at the market price plus primary income from the rest of the world, which is positive, minus primary income to the rest of the world, which is negative. Then what are we getting? We are getting 1,985,499. That's our national income. Then we move to the expenditure method. Remember, it measures total expenditure that incur within the country. So expenditure method is a system of calculating gross domestic product, GDP, that combines consumption, investment, government spending, and the net exports. This method comprises the sum of expenditure in the economy by all economic sectors, namely the household sector, business sector, the government sector, and the foreign sector. Spending that occurs within the borders of the country is regarded as the gross domestic expenditure. Whenever we are spending within, not spending foreign goods, not them spending on our goods, that simply means we have the gross domestic expenditure, which is total expenditure that occurs within the borders of the country. The gross domestic expenditure excludes the foreign sector. Why? Because the expenditure is taking place within the borders of the country. We don't include the foreign sector. Consumption spending by the household. What is meant by this? So this is normally the largest GDP component in the economy, consisting of private expenditure, household final consumption expenditure in the economy. And then personal expenditure fall under one of the following categories: durable, semi-durable, non-durable, as well as services. The consumption in the above classification creates the total consumption spending in the economy. So we add all types of consumptions, we put them together, then we get what we call consumption spending by the household, which is C. Investment spending by business, which is I. So investment includes business investment in equipment, but does not include exchange of existing assets. Spending by household, not government, on the new houses is also included in the investment. Household spending on personal property is also regarded as an investment in the economy. Whenever your parent is purchasing the house, that is regarded as an investment in the economy. Investment spending is the sum of spending on all assets. The government spending. So government spending is the sum of government expenditure on the final goods and services in the economy. It includes salaries of public servants, purchase of weapons for military force, and any investment expenditure by the government. Then we have a residual item, which is plus or minus. So this one correct errors that have occurred during the calculation of gross domestic expenditure. If a certain amount was not added on the maybe government spending, the money must be added, then we choose positive sign. If then a certain amount was added by mistake, maybe on firms, that amount of money must be subtracted because it was added wrongfully. So that's why residual item will be negative or positive, but provided on the statement that is given to you. If the statement is clear, then you choose the correct sign. Residual item correct calculation errors that are on consumption spending, investment spending, and the government spending. If there was an extra additional on the GDE calculation, residual tends to be negative. If a certain amount of money was added by mistake, it must be subtracted. So in that case, we get the gross domestic expenditure. If certain amount of money was omitted by mistake on calculating gross domestic expenditure, then a residual item must be positive because the amount of money that was not added should be added in there. The gross domestic expenditure exclude spending on exports and spending on imports. The net exports. Now remember, we're looking at the difference between exported goods and imported goods in terms of monetary value. GDP captures the amount of countries produces, including goods and services produced for other nations' consumption. Therefore, exports are added. GDP also captures the amount of foreign goods imported into the country. Their amount is subtracted. So in this situation, the amount of imported goods must be subtracted because the money flows out of the economy. The difference between exports and imports is called the net exports. So this is the expenditure method. We have final consumption expenditure by the household, which is C. Final consumption spending expenditure by the government, which is It's G. Gross capital formation, which is investment by businesses. Then we have residual item, which is negative. So we get the amount of is positive, then negative. We get the amount of in year A 1,578,472. In year B 2,071,343. That's our gross domestic expenditure. Then after that, we need to add payment for exports. So as we have received the income on exports, it is 430,169, 634,626. And then we must subtract import. With less import, they are negative because the money flows out. We minus 437,559, 689,784. Then we get GDP, gross domestic product at the market price using P, which is production method. That is our 1,571,082. In year A, year B is 2,016,185. Then we move to the production method. Remember, GDP is determined by calculating the sum of the value of added at each stage of production. So this method yields GDP at basic price, gross value added, if you like. So we have the primary sector, secondary and tertiary sector added together. So we know that primary sector in the economy does not contribute much because it only extracts raw material and collect them and send them to the to the secondary sector for transformation. The primary sector is the lowest contributor in South African economy because of the decline in agricultural opportunities, farming opportunities, and also because of what? Because of weather conditions that are not good. The contribution of primary sector has been declining over the past few years due to the decline in agricultural activities as well as mining. Primary sector deals with genetic operations and exploitative operations. Remember, genetic operations are the operations that can be renewed, but exploitative cannot be renewed. Secondary sector is a manufacturing sector. Secondary sector is the economic sector that processes raw materials from its natural state into final goods or finished goods. And then we continue. Secondary sector is also known as manufacturing sector within the economy because it manufactures goods. And then in secondary sector, natural resources or raw materials are transformed. They are transformed and given economic value. Remember, minerals or natural resources in a form of primary sector, they have not yet been transformed. They have a strategic value. But once they are transformed to the final product, they will be having even more monetary value or economic value. Secondary sector is the second highest contributor in South African economy. Why? Because it sells goods that have been transformed to final goods and serves even though they don't have value added. And then we talk about the tertiary sector. Tertiary sector is the economic sector that deals with the provision of of services in the economy. So it is also known as a services sector because it provides services. So services like transport services, banking services, insurance services, communication services, etc., repair services are found in the tertiary sector. Tertiary sector is the highest contributor into South African economy. Know the reason why it contributes the most, because it sells value-added goods. There have been 15% that has been added on those goods and services as a part of value-added tax. For that reason, it will always be having more revenues that has been generated compared to the primary and secondary sector. So this is the production method calculations. Primary sector positive, secondary positive, tertiary positive.